I've got some bad news about the housing market, and unfortunately, it's expected to be. Not as bad as you may expect. Here's why. A recent article noted 270,000 homebuyers who bought in 2022 are underwater on their mortgage. FHA loan delinquency rates are 150% above 2013 to 2018 levels. And if you watch Graham Stevens' channel, you'll realize that this introduction is surprisingly similar. This is where it diverges. The article title versus the actual content is vastly different. The majority of the 450,000 total underwater borrowers occurred this year in 2022, with 60% of originations occurring in the first 9 of 11 months. And even with 450,000 borrowers underwater total, it only represents 8% of buyers that purchased in 2022. The question becomes, is it significant or just the outcome of a market that peaked? And the second question is, what does that say about the future? Today we'll cover exactly that in 3 segments. The 3 segments are national housing and economic data, local data, and I'll conclude with my own thoughts. Now back to underwater borrowers. When you break down the buyer segment for mortgage type, you get this. Conventional loan accounts for the lion's share of mortgages at 82%, with VA at 9%, FHA at 8%, and USDA at 1%. VA loans are zero down payment required loans, with the majority of VA buyers putting down just that, 0. They also roll closing costs, including the VA funding fee, into the loan itself. That means the moment they close, they're already underwater by 3 to 5%. FHA and USD loans are both low down payment loans at 3.5%, with the majority of buyers using these loan types due to low credit. These combined segments account for 18% market share of loans significantly at risk of being underwater with any market correction. With home prices down 9% since peaking in June, according to Redfin's data center for all metro regions, that correction already happened, yet less than 50% of those high-risk buyers are underwater. While potentially risky for these buyers, the story is completely different for the majority. A clear bifurcation of risk has emerged between mortgage homes purchased relatively recently versus those bought early in or before the pandemic. By contrast, early payment default among those with conforming loans were more than 70% below early 2000 levels, and VA loans were less than half of that same threshold. So the systemic risk of underwater homes or mortgage defaults are at a historic low, and only for a small segment of those that bought the top. I said in my last monthly update here that prices would continue to decline as inflation continued running hotter than expected. Only with signs of inflation easing could the real estate market start to find that bottom. Now, since then, those signs continue to show, with yesterday's monthly CPI and core CPI numbers both being below expectations. You can directly see the impact on mortgage rates, with it dropping 11 basis points or 0.11% after the CPI print. Now, it's confirmed as of today that the Fed will give us our adult Christmas, and explained in my last video here. Even with these nuggets of good news, it doesn't mean the market will suddenly turn around or that it won't take years for the bottoming process to occur. Chairman Powell has been consistent and explicit in all of his speeches in the last 6 months.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%.
We will continue until the job is done. So while the future looks positive, there's a long path ahead of us. Looking at the local market here on Oahu, this is what history says. The 1990 recession had 13 years of sideways movement between 1991 and 2003, with the 2008 recession taking 7 years between 2007 and 2013. Now, if history repeats, it could take 7 to 13 years to break previous highs. Let's dive further into the Oahu market stats to see what's changed this past month. Let's start with median sales price. Single-family home prices surprisingly jumped 9.9% from last month. Now, this reverses a previous month's trend of a declining single-family market. We'll explore that thought right after we look at condos. Condo prices also reverted the increase from last month to drop 7.7% monthly. This really shows that variance that occurs in monthly stats. Markets don't just move straight down even if the general trend is there. Demand continues its trend down, but the question I ask is how interest rates dropping recently will impact that demand. Supply continues down as well, with sellers refusing to sell under their bottom line, which I'll cover very shortly. Now, the total supply continues to pick up, but it is reflecting a slowdown in that increase. This potential balance of buyers and sellers will flatten out those prices. What about homes that don't move? What about supply that comes on the market, or price reductions? Or what about sellers withdrawing their listings? Since these stats aren't available to compile, I'll reflect on it this way, by talking about market sentiment. For sellers, there's the reason they're selling and the price they're willing to sell it for. Redfin reflects that here. Sellers are taking their homes off the market because they're often receiving no offers for the price they want to sell for, and sometimes no offers at all. If they don't get their price, unless they absolutely need to, they'll just sell later. A Seattle agent confirms that with his clients, now people are talking about trying again in another year or two once the economy improves. I can confirm that with my own sellers, trying to negotiate down for my buyers and talking to other agents. You can confirm it for yourself by thinking if you'd do anything different if you were in this situation. Here's another example on Oahu. When COVID hit, tourism stopped, and Waikiki owners didn't know what to do about their condos. The majority shifted their short-term rentals to long-term rentals, and it really flooded the rental market. Rental prices tanked. Legislation was also passed and you couldn't kick out non-paying tenants, and even with all those issues, most owners didn't sell until 2 years later. To bring it back to where we are right now in the market, it's not only affecting sellers. Developers are starting to slow down on future projects due to low demand, while current projects are having to give additional credits like Ho'opili. Tight supply will keep these prices higher and longer than you think unless something like COVID happens again, or massive foreclosures, which the early part of this video disproves. Now, with interest rates over 1% off its peak, inflation looking to really turn a corner, and prices potentially forming a bottom, would you pull the trigger to buy? If you really want to make the best decision for you, pick the right realtor, start the process, and buy when you're ready. It's that simple. To find out how to pick the right realtor, subscribe now to be notified when that video drops, and I'll link it right here.